below the rate charge for the borrowing from the Fed. His second part of the exit, what we call the great exit, is that the Fed funds rate must accompany, increase in the Fed funds rate must accompany shrinkage in the Fed's balance sheet. That to change the Fed funds rate without getting rid of the securities on their balance sheet makes no sense, because the overhang from excess reserves is still there. It would appear it's sort of like apple pie without the apples. You just can't raise interest rates in a show of anti-inflationary monetary policy, yet at the same time permit excess reserves to be out there threatening the system. So his policy would be, if we raise interest rates, we're going to take away reserves. If we lower interest rates, we'll inject reserves. So you sort of a matching principle. And currently, as you know, they have $1.4 to $1.5 trillion in holdings, and he thinks we should reduce it to $50 billion.
Which is just amazing.
It's amazing, especially when you think of the speed at which these securities could be let loose on the public. The third part of his vision is to me a little troubling. His vision would be that the system's open market accounts, the holdings of securities, must change their composition today from mortgage-backed securities and other housing-related assets to almost strictly treasuries.
Which it was before the crisis.
Exactly. So apparently the securities he wants to unload are some which may be toxic, mortgage-backed securities. What other things would they don't hold any municipal securities.
Yeah.
So we're talking mostly mortgage-backs and agencies, I suspect. And he wants to get their portfolio, which they call the SOMA portfolio, back to almost all treasuries. So he leaked to us what they're going to sell.
Now, the one thing that was the maturities too, Ed, in terms of looking at the maturities that pre-crisis that you had shorter-term securities in the Fed portfolio.
Yes, he wants to go back to that.
Compared to the longer-term securities. So not only do you have a change in mix, but they're also looking at the fact that there would be a change in duration of the actual securities too, selling longer stuff, coming shorter.
Yeah. Prior to this crisis, about 90% of their holdings were in treasuries, and about a third of that were in bills.
Right.
Yeah. The fourth part of the exit strategy, Jay, is really an economic one. It has to do with the Fed's transparency. He wants to adopt a numerical inflation objective, 2% inflation, 2.5% inflation, and let the whole world know what it is. And if we did that, we'd have pretty good company. There are many banks around the country, reserve banks, that in fact do that. That this numerical objective would take away the part of the threat of this large balance sheet of securities. And it also could keep down inflation expectations, which would help that long end of the yield curve, which you and I are going to have to discuss in a moment. So that's the four keys to his proposal. And now let's talk about his actual plan. In other words, that's the foundation of the plan, those four keys. What does he actually say they should do? It's pretty amazing. First of all, he believes that the rates should increase and the balance sheet should decrease concurrently. So anytime the Fed raises interest rates, there's going to be a sale of securities in addition to those that run off. Tie the pace of the asset sales to the pace of the interest rate increases. If rates are rising quickly, the asset sales increase quickly. Move away from zero interest rates as soon as possible. He, like many of us, realized that zero interest rates are a non-starter. You just can't have that and expect a thriving banking industry. And we need to, he wants to stop the reinvestment program. He wants to stop the zero interest rates almost apparently very quickly. As soon as economic conditions permit, and this is another part of his policy, it's all related economic conditions. Raise interest rates to 50 basis points as quickly as possible. That in addition to allowing assets to run off as they mature or are prepaid, that there'd be an additional specified amount of sales each meeting, and what he calls continuous sales, so that the Fed would, on an ongoing basis, be shrinking their balance sheet. And I hope our customers can see the next slide, Jay. It's the Fed's path to interest rate normality, an exit strategy which normalizes rates in 12 months. I'd like you to comment on this, Jay. You can see that on the column headings we have meetings, which are usually every 6 weeks. So every 6 weeks, starting at some point in the future, and we don't know that date yet.
You get the bump to 50.
You get the original bump to 50, and then every meeting you get a what? Quarter of a point.
25 basis point increase.
Increase in the Fed funds rate. You can see that we start at 0.0 at 1.5 trillion, and we're moving off about 175 million after the first meeting, 175 billion dollars of securities every meeting period, until we get to the point where the portfolio the Fed holds is only 50 billion. Stunning in 9 meetings, which would be about a year.
Yeah, I mean, this really, the impact that this could have, which we'll talk about after we go through and look at the 18-month, would be, I still think.
Would you call this shock therapy?
Oh, yeah, definitely.
Well, there's a sort of a second, less aggressive path, Jay. Maybe you want to talk about this next slide. This has it in 18 months. And notice it starts again at 50 basis points. So he's recommending get out of zero interest rates immediately. Get to 50, which he apparently is proposing now,
right,
the spring of 2011. Then we have a 25 basis points, Jay, but over a period of 13 meetings, which is 18 months. And we get the Fed funds rate up to 3.5%.
And that would be closer, Ed, to, if you want to talk about normality, that would be closer to where we think of normality being in that 4% Fed fund level.
Yes. And notice also, Jay, that the forecast here now is for a $115, $117 billion a month sales of security, about 1/3 less than the previous exit strategy. So I would call this faster than the current strategy that's been out there, but not as shock-like as the previous one. And Jay, just to show you that the market reacts to things like this, we went on we measured the probability of a rate hike before and after the speech. And I'd like you to comment on this. As our viewers can look at, on the first column, there's the upcoming FOMC meetings. And you can take the volume and pricing of the futures market, interest rate futures market, and get an estimate of the probability of what the market thinks the rate's going to do. And there's been significant change, Jay, in just a week. Before and after the meeting, the red numbers, the red fonts represents the most current post-meeting feeling of interest rates. The black fonts represents the previous, before speech feelings of the market. And I would view the black fonts as the slower 5-year.
That's right.
Withdrawing, sucking back the liquidity. And I would view the red as certainly not the short shock model or even the 18th, but the possibility that it exists. Do you agree with that?
Absolutely.
And as you can see, there's been some pretty significant change, Jay. For example, at the end of the year, the 12-13 meeting, the end of 2011, prior to the speech, there was a 8.9% probability, for example, that the market thought rates would be 75 basis points. Now there's a 13% probability. An increase of about 5%, and just the speech caused the market move that
Yeah,
much.
where you look at the different economic factors in here, Ed, could argue that there should be no change in rates just based upon where with oil and the whole Japanese situation seems to essentially say there wouldn't be any change in rates, where this looking out into the future is now expecting where before there was little expectation of interest rates increasing, now 75, 100 basis points is in the money.
Yeah, it looks like the market has taken Plosser at its word and putting some credence to his presentation. This last slide, Jay, I think is worth, again, viewing because I know many of our listeners are skeptical of QE1 and QE2. They really don't see the impact, macroeconomic effects of it. This is from the Fed's model, Jay, and I'd like everyone to take a look at it. The dotted red line represents the Fed's model of what the economy would look like if they never did QE1 and QE2. The blue line represents what happened in the forecast since we have done QE1 and QE2. The left slide is unemployment, the right is core inflation. And what's interesting to me, Jay, that the Fed really feels that we would have double-digit unemployment rate, note the red line, well into 2012 if we didn't do QE1 and QE2. We'd be above 10. But what's interesting is even by 2018, under both scenarios, with and without QE1 and QE2, they're not forecasting much below 6%, are they?
No.
And they're forecasting elevated inflation for the next 6 years. Now this smacks in the face of Plosser's exit. Are we really going to take away that liquidity when unemployment is 8, 9%? And so in other words,